As you can see, the title of the talk is The Waiting Game. And really that references that in the last 3 or 4 months, there's been a surprising sort of turnaround, not at the sector level, not by guys like me that follow the sector all the time, but I've had a lot more interaction with and seen a lot more positive views from generalists, I would say, index guys who normally don't really pay that much attention to this sector. There seems to be a fairly broad generalist view that we're going to see a move fairly soon in probably both base metals and gold. I mean, they trade for slightly different reasons, but I think the basic feeling is, even sort of long-term equity bulls that think that the SPX is going to go up forever, everybody knows in their heart of hearts that if we're not in the late stage of the cycle, we got to be damn close to it, and that's really just common sense for how long the cycle's been. I mean, it's already the second longest economic expansion in U.S. history, and it's not very far from being the longest. Common sense alone tells you we got to be getting close to the end of it. The question is whether we do see the sort of movement in commodities and gold and a number of other things that is normally the hallmark of the late cycle. We're not quite there yet, but it looks like we're starting to get there. I'm not going to waste a lot of time with reading the slides. I mean, there will be a copy that's available. But essentially, there's a lot of evidence across several different economic blocks that we are finally starting to sort of get into the late stage pattern. And really, the late stage in a classic economic cycle is simply that you're starting to hit the point of capacity constraints, be that low unemployment, capacity utilization, depletion and difficulty in growing overall production in, say, the resource businesses, for instance, enough metal, enough oil, enough copper, enough gold, whatever. And that's when you start seeing cost push. That's when you start seeing inflation. And traditionally, the periods where you're seeing this rising inflation towards the end of the cycle, that's when commodities and precious metals do best. And it looks like we're getting there now. And the best example I can give you is this is basically the producer price index. It's one of several different inflation measures. This is a very long-term chart. Goes back about 40 years. The gray bars that you see there are recessions, and you can see, if you look at this trace, as you get near the end of these long cycles, just before you get into the recessionary periods, that's when you really see the curve steepen. That's your inflation steepening. That's when prices are broadly starting to go up. That's usually the period where the central bank, for some time, sometimes for a long time, ends up getting behind the curve, which is to say they're not raising rates as quickly as the inflation is moving. That's what generates negative interest rates. And I've talked about this in the past in different venues. I mean, if you can look for any one sort of economic model, any one economic metric that's going to give you, in my opinion, the most reliable evidence that you're going to have a really good period for commodities and precious metals in particular, it's negative interest rates. We've come out of that a little bit in the last little while because the Fed's getting a bit more aggressive, but I think we may be about ready to go back into it. Another view of this that I wanted to give you, this is a shorter term view. This is the Goldman Sachs Commodity Index. I mean, it's a handy one because it's been around for a very long time. It's one of those indexes you can actually chart back for like 100 years. You can see basically in the last 5 or 6 months, we've had a relatively strong move off the bottom from the end of 2015, early 2016. We've now finally cleared the short-term high that we had in 2015. We're sort of back to climbing up that wall where things really fell apart in 2014, and a lot of that was oil. This index, the one weakness of it is fairly oil heavy when it comes to how the value is. But I think this is a good indication that we're definitely moving back into that period where this stuff is really starting to move and move together. A couple of fairly common inflation measures, but these aren't the headline CPI ones. These are ones that come out of different surveys, and they generally tend to move before CPI. They're earlier in the chain, if you will. The one on the left is the PPI goods inflation that comes out of the Philly Fed surveys. They do constant monthly surveys of manufacturers and service companies. The one on the right is from Market. They're the ones that produce the market indicators every month. There's a survey that's a service one and a manufacturing one. That's the manufacturing index that does have a lot of weight and gets reacted to fairly heavily. This is sort of a subset of that survey that they do every month. And you can see on both of them, if you look at where I've drawn the ovals on the right side, you're seeing the measures of those two separate surveys, and that's the light blue line on the left, the green line on the right. Those have steeply moved very, very, very heavily in the last 2 or 3 months. You can't see them very well. It's a yellow line on the right, so it's really hard to see, but the black line in the left chart, that is the actual PPI reading. So essentially the numbers that get generated by these surveys, you should see the price movement show up 3 or 4 months before it actually shows up in the official PPI. And you can see the PPI hasn't really done anything yet. It hasn't really moved. But if you believe in the efficacy of these surveys, we should see inflation start climbing here fairly soon. And I just want to preface all of this by saying I'm not an inflation hawk. I'm not a gold bug. Oh my God, we're all going to die. Inflation's going to go to 10 million. Like I'm not expecting anything dramatic, but we don't need that. If inflation goes to 3.5% in the current regime that we've got, that would be enough to have some big impacts. And just following along on that, part of because bond traders are smelling inflation, what do bond traders do when they feel inflation's coming? They sell. If you're a bond trader and you think inflation's going to start ramping, you start selling stuff. A bunch of bond traders sell bonds. What happens? The yield goes up. I mean, it's basically an inverse relationship. The cheaper the bond is, the higher the yield to maturity is. That's just how the math works. And you've seen the impact of that over the last, say, 9 months. You can see a fairly big lift here going back in the TNX. TNX is the 10-year U.S. Treasury certificate. It's one of the most widely distributed. It's one of the most liquid securities around, so it's a very common one that's used. There are certain mortgage series and stuff that use this yield to price themselves because it trades heavily every day. And then the other thing that you saw, it went up to about 3%. The market wasn't happy about that. Part of the reason we had this sell-off in January in New York was the TNX hitting 3%. That freaked a lot of guys out. It pulled back and consolidated a little bit. It's moved up again. We're back up. Right now, we're just kind of trading on both sides of 3%. The second move up, if you look on the chart on the right, you really saw that second leg up and more serious talk about rate hikes by the Fed and by the new Fed chairman. I think that really had an impact on the US dollar. You see a really strong move there at the end. The other reason why the dollar moved that much is because the euro, which makes up about 50% of the US dollar index, was just getting killed at the same time. Europe simply put a long string of below consensus numbers from just about every economy in Europe. They all just suddenly started underperforming. So guys were hitting the bid on the euro, selling the euro, buying the dollar. That just made that move stronger. We've had a move now to about 94 in the US dollar index. To me, it feels like it's probably not going to move a lot farther. I think we need to see concrete evidence that things are really, really accelerating in the US, or things really need to fall apart in Europe. Like it has to get better on one side, worse on the other for us to see much more move. I think we're going to flatten out here, but I'm going to go into that momentarily. So essentially, as you can imagine, there was predictable results. Both the US dollar and the yields go up. The US dollar moves up, gold gets hit. Gold looked like it was finally going to reach that 360 barrier and go through that glass ceiling about a month and a half ago. No such luck. Things turned around. It sold all the way back under 1,300. It's climbed back above 1,300 in the last couple of sessions. And it does look like the dollar and potentially rates, at least for the short term, are flattening out. But I threw both these charts up. The one on the right, the one on the left is gold. The one on the right is HUI, which is probably the longest standing gold miners index, sub-index that's still around. It's not that easy to see, but if you look at the right side of the HUI chart, this thing actually, sucker actually works. You see where we really got taken out to the woodshed there in the last few weeks before it bottomed out. Interestingly, through that same period on UE, it did not react that way. It actually climbed while gold was getting pounded, which is fairly unusual. It's not unheard of, but it's a bit unusual. And I consider this a fairly bullish sign, because what that's telling me is that buyers, and I suspect they're probably not traditional gold stock buyers, they're probably guys from outside the sector. They've decided that, you know, the gold market's time is coming, at least as they perceive it. And they've been actually putting a bid under gold stocks, even though gold was getting killed, which is why, even with gold backing off, you did see a trend in the other direction. Not a strong trend, but the fact there was an uptrend at all actually impressed me. I mean, that actually gave me a lot more comfort. And the final little piece of that puzzle that I think is important, that just came out a couple of days ago, if you take a look at this, is basically monthly purchases of gold ETFs, and most of the gold ETFs are, I mean, some of them are traders, some of them are guys that deal with bullion, but a lot of them are generalists. Last month was $3 billion in purchases in the gold ETF. That's the biggest month in over a year. Again, there's money from, I think, generalist money moving into this area again. People are just seeing this classic end of the cycle movement. The other thing that I think is possible that'll also help the gold market, I mean, we're sort of in a corrective phase right now in the S&P. It has had a bit of a climb in the last month or so. You know, maybe the worst is over, but one thing that I think is worth noting, this is a survey that gets done weekly by Investors Intelligence. It's a fairly well-known survey. It's kind of a bull-bear survey. They do this every week to just get a feel for whether investors in general are feeling bullish or bearish. And essentially this line here is simply this subtracted from this. So it's sort of a bull-bear percentage. And one thing that's interesting to note is in this last little while, even in the midst of that big pullback, big-ish pullback we saw in the S&P, you really didn't see a decline in bullishness. I mean, I find investors in the generalists on Wall Street are still probably a little more bullish than they should be. I mean, they take a different message than I do from the New York coming through what's arguably the best earnings season it's ever had in history, and not really having a hell of a lot to show for it in terms of how the stocks moved. I don't consider that a particularly bullish sign. I mean, I don't think I don't think it's the end of the world or there's Armageddon coming or anything. But I think New York is going to have to fight for its gains. I mean, I think the fun, easy, it goes up every day days are probably over. The other thing that I find interesting too, this is, you know, I feel sorry for whoever the hell has to do this, but somebody actually sits down and goes through the Fed minutes at every one of those meetings, and they literally look at the verbiage all the way through, start to finish. And what this measure is basically the number of times when one of the Fed governors during these monthly minutes that get recorded and sent out 3 or 4 weeks later talks about the economy being strong. That's the highest reading they've ever had. In other words, they're saying it over and over and over and over again. There's a similar survey that's sort of reversed where they did a count of how many times they were talked about uncertainty. It's at an all-time low. You know, that tells me that perhaps we're not going to, this is going to sound counterintuitive, but most of this stuff is counterintuitive. That tells me that I think there's some chance we're probably actually going to see less rate increases than I was expecting even a month ago. I simply think the Fed and Wall Street in general is overconfident, and they think they've got it all figured out. And in my experience, when the market starts thinking that, bad shit happens. When everybody gets cocky, it usually doesn't end well. And again, to look at a couple of these other things that sort of feeds into that feeds into why we might see some of this stuff turn, just on a trading level, not even on the longer term big cycle level. The chart on the left is basically the long-short positioning for long U.S. Treasuries. So basically, when that line's above zero, that means the net positioning is long. There's more people that own long contracts than short. Right now, it's enormously short, which basically means all of these traders think bond prices are going to fall farther, yields are going to go higher in the near term. The simple truth is when the positioning gets this far out of whack, you tend to get a reaction in the other direction, because the only way to, unless you're planning to take delivery or make delivery on these bonds, at some point you got to close these things out. So I think just seeing some rebalancing and mean going back to the mean on some of this stuff, I think we may actually see the yields pull back a little bit, which will help the gold story in the short term. The other thing, and this is something that I had this in an issue about a month ago, one of my newsletter issues, and it's a bit of a head scratcher for me, and I haven't seen an explanation for it yet. I'm not sure what it means, other than that, you know, I'm a little bit less convinced than the market is about how much the U.S. economy is going to accelerate. What you've got here is two different lines. There's two different sets of indicators. Basically, the dark line is predominantly survey indicators. In other words, that's one where, say, 1,000 purchasing managers get phoned and go, what do you think your sales are going to be in Q3? How much do you think you'll be increasing orders? In other words, they're survey sentiment based. They're not really quantitative surveys. They're qualitative surveys. And then the light green line that you see, those are actual, like, hard number surveys. So like monthly truck sales, real estate transactions, actual imports, exports, that sort of thing. There's a divergence that I don't think I've ever seen before between how much more positive the survey numbers are than the actual hard numbers. And if you look at these two things, if you look back in that chart that goes back about 20 years, these things tend to stay pretty close together. That divergence is extremely unusual. And what that tells me, in my experience, the hard surveys are the ones that I'm more comfortable with. So what that's telling me is Wall Street's basically pricing things really by and large based on this, because these sentiment surveys move the market a lot, but I suspect the real number is going to look more like this. So if you take that one, it's going to be, oh, we're going to see 4 or 5% growth the rest of this year. You take this one, it's more like 2.5. 2.5 is where I'm hanging my hat right now, which is fine. We're all just fine and dandy with 2.5%, but it's not going to give you the blowout, and it's probably going to increase the odds that you get a little more focus in other sectors like the one that we're in. And just to sort of finish off that part of it, this is really the main part of it. Part of the reason I mentioned why the dollar did so well was because the euro did so badly. The other thing that's happened in the last little while with this big dollar move, you know, you're starting to see the heavy move in the US dollar negatively impact things in the US. This is what's called the Economic Surprise Index, and basically it's, you know, if they put out car sales or payroll report or Q3 GDP, whatever the hell it is, there's always a consensus number, and basically if it's above consensus, it's a positive surprise, below it's a negative. So they just track this, and when you see that line moving down like that, that's telling you that more and more things are missing consensus. So again, this is a measure that I think a lot of the market is being a little bit overconfident about the numbers that are coming in. The other thing that's worth noting, and it's definitely had an impact in some of the countries that are being worked in. I don't know if it's having an impact in Peru. It's definitely having an impact in Argentina, but there's several international markets where the currencies are just getting killed. The other side of this strong dollar trade is EM currencies just getting smashed pretty hard. I mean, that's like a 9% move in a month. Like, that's a huge move for a currency block. It's massive. And those kind of things create dislocations. Most of it's happening in relatively smallish economies, Turkey, Argentina. I don't think it's that big a deal, but it's one of those things that's worth keeping half an eye on. Those of you who've been around as long as I have and go back and think about like the Asian crisis in the 90s and stuff, that's really how that started, was by massive currency dislocations, and things just got completely out of whack. I think the whole world economy is a little bit more, it's better set up for this kind of situation, so I don't really think we'd see a recurrence. But again, it's one of those things where, you know, temper that optimism a little bit. So to bring it all to a summary here, I mean, essentially, the idea is that now that we're in this late part of the cycle, we should start seeing a bit of an inflation move. I don't expect much, but we don't need much. That is at times when metals and precious metals both perform best. I think with a little bit of inflation and some real rate drop, I expect gold to actually do fairly well towards the end of this year, and probably even better next year. Silver, I'm not a silver bug, but I assume it just gets pulled along for the ride. It often has higher percentage returns. We're seeing growing evidence that we're probably going to see copper go into deficit. It's sort of almost there right now in terms of production deficit. That's not something that's going to get fixed in the short term. I've actually turned around and become a lot more bullish on copper than I was 6 months ago. And as long as the world economy holds together, I don't think this will be a short-term phenomenon. I think we'll have good copper prices for an extended period, perhaps a very extended period. I'm still comfortable with zinc. Yeah, there's some stuff coming on stream. Yes, we've seen inventories climb. But if you look at historic inventory levels, it's really nothing compared to what your average year is. So while I'm not necessarily certain zinc's going to go back to, and hit $2 like I thought it might have at the start of this year, I won't be surprised if it stays up in the 120 to 150 range, again, for an extended period. All of that's enough stuff to not necessarily lift all boats, but it gives us enough of a market backdrop where good companies get financed and good companies with good management will get reaction to good news. And that's basically my one-slide summary that goes past all of the mumbo-jumbo. Basically, uncertain but positive market, go with quality. That means high-impact exploration stories, strong management. By high impact, I mean exploration targets where your target scale is very large in relation to the value of the company. So if they hit on the target, it's an exploration, so they still have to hit. If they hit on the target, the scale is large enough to meaningfully and significantly impact the value of the company. In other words, it could go up a hell of a lot if it works. At the other end of things, you look for developers that have projects that either have the scale or the grade to be top quartile, management that knows how to push things forward and obviously has the market's attention. And really sometimes the best way to see that is that they're trading well or that they're able to raise money. Non-coincidentally, you will find that the companies sitting to my left fit either one or the other of those categories. There's what I would call there's a developer that's almost ready for a production decision that I already know will be positive. There's one that's building a very large resource. There's one that's probably still building a resource but still doing more exploration. And then there's another one that's a flat-out drill spec. So we're going to hear from each one of these types of companies. We're going to start off with John Black.